If you're a landlord, a buy-to-let investor, professional real estate investor, you will know that the government has brought in a raft of legislation in recent times attacking this very sector, attacking your sector. So briefly, what has the government brought in to make our lives more difficult from a tax perspective for those of us into property? Well, firstly, there was the introduction of the 3% stamp duty surcharge. So any purchase of a property which is not your first property, i.e. not your main residence, will give rise to an additional 3% surcharge on top of the normal stamp duty rates. Secondly, there was the removal of the wear and tear allowance, which gave a free 10% tax deduction for letting furnished properties. So 10% of the gross rents would be available as a tax deduction, which could have been worth up to 40-45% for some of you taxpayers out there who pay tax at the higher rates. And thirdly, the removal of mortgage interest. So being phased in over a period of time from 2017-18 up until 2020-21, when the availability of tax relief on any mortgage interest paid will be removed entirely for higher rate taxpayers from tax year 2020-21 onwards. So, what does that now mean for buy-to-let landlords, professional investors? How now to structure affairs to be as tax efficient as possible? Well, a question I get asked quite a lot is, which structure should I go with now? Should I continue to buy property in my personal name? Should I buy property in partnership? Should I buy property in an LLP? Should I buy property in a limited company? Well, every case in tax is unique and based on your particular circumstances. So this is not advice, but as a general rule of thumb. Now, if you're a high rate taxpayer and you are quite highly geared on your portfolio and you're planning to expand by using leverage, by using debt, then your tax payable will increase as a result of these changes by not being able to offset your mortgage interest against the rents received. Similarly, if you are a cash investor, then this particular change and removal of a mortgage interest will not really make much difference to you. So for you, if you continue to buy property in your personal names, this particular change in the legislation will not have much impact. So let's assume on the basis that you are looking to grow and everyone's objective is different. The company route is now a bit more attractive, a bit more appealing. So what's different about owning property in a company, and how much more advantageous is it? Well, for a start, as we said, mortgage interest relief is not available for high rate taxpayers from 2020-21 as a tax deduction. It will continue, or is currently and is foreseen to be available for companies to offset in full. That means any interest that you pay on a loan taken out to buy an investment property or to remortgage against an existing portfolio, you can claim the mortgage interest relief in full in the company and offset it against your company profits. Now, the biggest difference between owning property through a company and owning it personally is that you are separate to the company in terms of legal entity. Whereas owning it personally, that's everything you are taxed on in your own names. When you sell it, you are taxed to capital gains tax. In a company, the company is a separate legal entity from yourself. That means that the company is accessible to tax on its own profit, and if you then want to access those profits as a shareholder, you then pay income tax on getting that out. However, there are flexible ways of structuring it so that it can be made tax efficient, but certainly on the point of mortgage interest tax relief availability, the company is where you can get tax deduction in full. So what other considerations should there be had when purchasing property through a company? Well, for a start, it depends on whether you are looking to grow your portfolio and earn an income return from it, or whether you're looking to buy properties, renovate them, develop them, and then sell them off. And there are different tax treatments and implications of both. So firstly, it's important to know what your objectives are in terms of your property investment activity and the long-term game. This is because the way that the capital gains tax works in a company is also different. So if you were planning on buying property and then selling it in a few years' time to earn a profit, then the company would pay corporation tax on the gain, so the increase in value. That would then be in the company, and if you wanted access to that, then you would pay tax on getting it out. So again, consideration needs to be had on whether you will need access to lump sums in the near future, or whether you are planning on building a big portfolio, and the fact that, and you will not need access to lump sums, big amounts of cash from the company. You are content that any profit made on a sale will be reinvested into other properties to grow your overall portfolio. So are there any other considerations? Well, stamp duty. Stamp duty applies to companies as well as individuals, and unfortunately there's no exemption for the first property that the company owns. It is the surcharge applies from the first investment of a company. There are obviously other matters to consider, but hopefully this has given you a brief overview of some of the implications involved, and will then lead you on to taking specific advice on your particular circumstances. If you'd like to book a strategic consultation with me to go through your particular circumstances, feel free to drop me a message, private message, or a comment, and I'll get in touch with you to have that arranged. I hope you found this useful. Until the next time, bye for now.